down 80.9% in 2022. Is Vimeo stock a buy for 2023? I'm going to answer that question using several important metrics in this video, so stay tuned. Starting with Vimeo's revenue growth quarterly and revenue over the last going back to July before 2020. And looking at that, you can see revenue was just below 60 million before July of 2020. It has jumped up to 108 million in its most recent quarter. So the company is still growing on the top line as it adds to its customer growth and average revenue per user. However, revenue growth, when you look at it year over year, that's been decelerating rapidly, and this is what has investors concerned. It was growing at a near 60% clip early in 2021. That's fallen to an 8% clip in its most recent quarter. Moving on, looking at its operating income and operating profit margin. Starting with operating income, it was on a nice trajectory from 2020 to 2021, and then it started collapsing as the company ramped up hiring, ramped up its sales force and tech team. Now it's going in the opposite direction. Operating profitability is falling, going down to 22.88 million in its most recent quarter after it was making progress to reach profitability. This is not the direction investors like to see a company go into, and that can partly explain why the stock was down so much in 2022. If you look at the operating profit margin, it tells a similar story. The margin was improving and then started falling precipitously, going from negative 12% all the way down to negative 23% in the trailing 12 months. This is not good news. This is not good news, especially as the Federal Reserve has ramped up interest rates and investors have lost patience with these companies that are growing rapidly on the top line but losing a lot of money on the bottom line. And so these stocks have been sold off. Vimeo has not been an exception to the rule. That's why the stock is down so much. Next, let's look at its cash flow from operations. And thankfully for investors that Vimeo is still generating somewhat positive cash flow from operations, 9.95 million in its most recent quarter. This is up from losing 30 million and a little over 15 million in the previous two quarters. The company has fluctuated between generating cash flow from operations and losing cash from operations, but this upward trend can be encouraging to investors. And you might ask, how can a company generate positive cash flow from operations but be losing so much money on the bottom line? And for a tech company, this is most likely explained because they're using a lot of stock-based compensation, which is not a cash expense. So they're paying employees with stock options and stock grants instead of cash. And while they need to account for this on the income statement as an expense, this is not a cash outflow, which makes its cash flow from operations positive, where its operating profitability is negative. Finally, let's look at its valuation to determine if this stock is a buy. If we look at the price to free cash flow, it's trading at a very expensive valuation of 127. Again, the cash flow was not consistent. So looking at this metric is not very informative because we don't have very much data on this. And then looking at the forward PE ratio is similarly less informative because it has very little expectations for profitability. The forward PE is 469.78. Again, not very informative. The company has not been consistently profitable, so we can exclude the information given by these two metrics and focus more on the price to sales ratio at 1.532. This is the cheapest the stock has sold for since it became a publicly traded company. At one point, it was trading at a price to sales ratio of 30, which in my opinion it never deserved. But of course, in 2021, there was a lot of stocks that were trading more expensive than they should have been, as investor enthusiasm for growth stocks was exploding, and now they've come back down to reality as the Federal Reserve has increased interest rates and the company's explosive growth is slowing down as economies have reopened. So to answer the question, is Vimeo stock a buy for 2023? I'm going to say no, it's not a buy for 2023. The company has troubling trends with decelerating revenue growth and worsening operating profitability at a time when investor enthusiasm for these kinds of metrics are waning. So this is not a time I would want to be investing in Vimeo stock. All right, that's all I've got for this video. Thanks for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.